All right, welcome to Talk Tickers. So, GE HealthCare dropped its fourth quarter earnings on February 4th. And what happened? The stock popped, jumping almost 5%. The question is, what was in that report that got investors so excited? Well, let's break down the call and figure it out.
So, you see this number, a rally of nearly 5% on the day. But when you actually dig into the report, the picture was, well, it was kind of mixed. They had some pretty significant pressure on their margins. So, what gives? What did the market see that wasn't immediately obvious from the headline numbers? And here's the deal. The story here is that the market basically decided to look right through the short-term noise. Investors were way more focused on the stronger, forward-looking narrative, which is all about management's great execution and a really robust outlook for 2026.
Okay, so let's start with the basics, the headline numbers. GE HealthCare delivered let's call it a narrow beat on adjusted EPS and a more solid beat on revenue. So, not a blockbuster quarter, right? But it does show that they're executing and hitting their targets. Now, let's get into the nitty-gritty, because the real story here, the really interesting part, isn't in those small beats. It's in the operational metrics that management was really eager to highlight as proof of the business's underlying strength. First up, a record backlog of $21.8 billion. You know, management loves this number. They actually call it their air cover. It gives them incredibly clear revenue visibility for 2026, and more importantly, it shows investors that demand is really strong. And get this, that backlog is still growing. With a book-to-bill ratio of 1.06, it means new orders are coming in faster than they're shipping products out the door. That is a classic, clear sign of a very healthy demand environment. But, okay, it wasn't all good news. Here's the number that really gave investors pause. A 200 basis point drop in adjusted EBIT margin year over year. That's a full 2%. This was the single biggest challenge of the quarter, and it was pretty much all driven by one major headwind. This slide really puts it all into perspective. You can see that margin compression right there. But management was smart. They broke down the impact of tariffs specifically. A $100 million hit to margins and a $90 million hit to cash flow. Now, if you take that out, the numbers look a whole lot stronger. The market saw this and basically said, okay, this is a policy issue, not an operational failure. So the crucial point is this. If tariffs are the clear villain in the story, how is management fighting back? This is where their self-help story comes into play, and it's all about internal initiatives to control their own destiny. And the core of this whole strategy is a system they call Heartbeat. The easiest way to think about it is like their own version of the famous Toyota production system. It's just a super disciplined, data-driven approach to wringing out inefficiencies across the entire business. And listen, this isn't just a bunch of corporate speak. The CEO gave a really concrete example of how this is working. They've reduced their past due backlog by 25% per month. That's huge, because it means they're turning orders into revenue and cash much, much faster. So here's their game plan to deal with those tariffs. It's not just talk, it's all action. They're actually moving manufacturing for key products to the US. They're finding new suppliers to cut costs. This is exactly the kind of specific, credible plan that investors love to see. Now, let's look ahead to the 2026 outlook. The official guidance is what really strengthens the bull case for this stock, but, and it's a big but, it comes with a major caveat. And here it is, even with the whole tariff issue. They're guiding for solid organic growth, margin expansion of 50 to 80 basis points, and 8 to 12% growth in adjusted EPS. Now this is the kind of forward-looking guidance that gets investors really excited. But management was quick to balance that optimism with a big dose of reality from the CFO. He was very clear. They are building a decline in China into their guidance. This is the biggest risk on the horizon for sure, but it also shows that their outlook is realistic, not overly optimistic. So, what should you be watching for? I'd keep an eye on three things. First, their Q1 execution. That's when they'll feel the biggest hit from tariffs. Second, how well that massive backlog actually converts into real revenue. And finally, any news, any data point out of China. If that market stabilizes, it would be a huge plus for the stock. Okay, so let's put it all together. What's our take here at Talk Tickers for the next call? And how do we see this playing out for the stock? We're predicting a beat in Q1. Management has set a pretty low bar with all their warnings on tariffs in China, and their execution has been really strong. We expect the stock to probably trade in a range for a bit, consolidate, as the market waits for more proof.
The risk-reward feels balanced, so we're giving it a market perform rating. The self-help story is compelling, no doubt, but those macro headwinds are real. The big question is, can their internal execution continue to overpower those external pressures? And of course, this is not financial advice.